Now, our next guest tracks daily short-selling data. He says short sellers are scrambling to catch up with the surging price of bullion. Since March, short interest in gold ETFs has been fading. Will Duff Gordon, senior research analyst at Data Explorers, joins me now. Hi, Will. Thanks for joining us today. Just explain short interest in ETFs for our viewers that might not be familiar with this.
Yeah, so this is they're sort of a perfect instrument for those people who are thinking, oh, I wonder whether we should, we're a little bit nervous about our long positions, perhaps in gold.
Yeah.
We think gold may be about to turn the corner. Can it sustain these highs? So maybe, but we're not so nervous that we want to basically sell all our gold holdings. So maybe the first thing you can do is to short sell basically a basket of gold, which is through the gold ETF, like GLD is one of them. And then you're essentially protecting your downside a little bit.
So it's a good way of hedging.
It's a great hedging instrument, exactly.
Yeah, there has been a lot of focus on ETFs. We'll come to short selling in a minute. But ETFs as a whole recently, the FSB says they cause a massive risk of causing a new financial crisis. They should be put under the spotlight. Were their criticisms fair?
They were. Clearly, everyone wants to improve every new instrument, and transparency is great, and everyone's in favor of that. On the other hand, I think people have been saying it's gone quite far. People have lost sight of the fact that ETFs are a very cheap, less risky, easy way to invest, and you're not taking any specific company risk. So I think saying that they are kind of like the next sort of securitization issue is going a bit far, and that they're going to create counterparty risks and greater volatility in the market.
Of course, many funds don't hold the asset they're actually invested in, aren't they? And that's the area where concern centers.
Not really, because there's two types of ETFs, and by far the most sort of prevalent ones are the ones that are physically backed.
Yeah.
So the synthetic and the physically backed. Clearly, investors need to understand if you are, getting exposed to nickel or thermal coal through a synthetically backed ETF, it's somewhat different to say buying a physically backed ETF with exposure to the Russell 3000, for instance.
Tell us the different strategies investors then can adopt when using short selling for ETFs.
Well, so the US hedge funds are past masters at this, and it's happening more in Europe. It's just a hedge fund is there to hedge. It's there to make money in a down market as well as an up market. So it's natural that they are going to basically short sell plenty of ETFs in those areas where their fund is long. Hence, looking at sort of ETF short selling data can be the kind of canary in the coal mine, the early warning system that people sometimes think showing signs of being nervousness, shall we say, about where they have gone strategically long. So, for instance, you see quite a lot of action in the EEM, the iShares Emerging Markets ETF. Now, that's the borrowing, the short selling of that is coming down, showing that people are kind of putting money back into the emerging markets and are not so worried about it, whereas they're starting to short sell the SPY, the S&P 500 ETF, as in that, are they thinking that the US market is running out of steam there?
Okay, well, thanks very much for joining us today. Look forward to speaking to you again soon, and learn more by visiting this story on the new Bloomberg.com website. But just ahead of that, I want to just tell you can track short selling data on the terminal by visiting DXPL Go. DXPL Go for tracking short selling data on the terminal.